Yes. So, this is the fourth chapter, fourth part of chapter one. We learned about, the scope, who are the constituent entities, and who is the UP slash IP. Now, another important thing that we have to understand is there is something called excluded entity. Okay, given the constituent entity list, some entities may be excluded based on what they do, or their nature, or their shareholding, or their basic functionality. So let's understand this. So after completing this chapter, you'll be able to determine whether any constituent entities qualify as excluded entities under global rules. And then we will see how you should document these exclusions separately and what are the working papers that we have to maintain as a taxpayer. Okay. So why excluded entities matter? Certain entities are excluded from globe calculations altogether. So if it is a constituent entity, it will not be taken in. Okay. These excluded entities are not included in the jurisdictional ATR calculations. Their income and taxes are carved out from the group computations. Okay. And what is very important is if we misclassify entity as an excluded entity, then it could lead to incorrect top-up tax calculations also. So it's all about deciding which entities are excluded entities. So, moral of the story is certain entities will not be counted for determining globe income. But if certain entities are excluded, so we will learn about who the excluded entities are. But another important question is: would their revenue be taken for determining whether we come into scope? That is, whether their revenue, excluded entities' revenue, would also be taken to determine whether we come in EUR 750 million scope. What do you think? See, their calculations, their tax, even if they are a low tax entity, we will not be topping up taxes and all for them. But would their revenue be taken for determining whether we come into the scope or not? Answer is yes. Okay. So don't get confused. Even if they are an excluded entity, the revenue would be taken for chapter 1.1 purposes for the scope determination. Okay. Now, what are the excluded entities? There are five categories of excluded entities. First one is government entities. Okay. If any constituent entity is a government entity, a government political subdivision, a local authority, or an agency or instrumentality wholly owned by the government. So, what is the example of an agency or instrumentality wholly owned by the government? Road transport agency. It's wholly owned by the government, right? So, if there are situations like this, if it's a government, state government or local government or political subdivision or local authority or an agency or instrumentality wholly owned by the government or a body, which basically could be a body corporate also, performing government functions, regulatory, administrative, other, with majority government control, then these entities are excluded. Now, I want to draw some similar parallel with the entities which are excluded or exempt entities as per the UAE corporate tax law. We had a class of exempt entities before also. You can see that there could be a very similar parallel line that could be drawn in terms of excluded entities for webs also. So, government was excluded there and government entity was also excluded there. The same would go here. But same like UAE city, yeah, if a government entity is carrying on a trade or a business, would they be excluded? Was a government entity carrying on trade or business excluded for UACT? No, right? Similarly, if it is carrying out trading or investing, or they're competing with the private sector folks, then it is not an excluded entity, even if it is wholly owned by the government. But if it carries out government functions only, then it is an excluded entity. So you have to see if they are carrying out a business in competition with a local with a private person, then it is not an excluded entity. But if it is doing only sovereign activities, yes, it is an excluded entity. Okay, so this is regarding government entity. Category two is international organization. So, what is an international organization? International or an international organization qualifies for exclusion if it is established by a treaty or international agreement between governments. Okay, so there are a lot of international agreements. NATO, which is in the news very popularly now, is an international agreement. It is an entity because of an international agreement. We have the UN, which is a treaty. We have the OECD as well, which is or the European Union, etc. So if it's an international organization established by a treaty or international agreement between governments, and it has an headquarters agreement granting tax privileges, and has income that do not accrue to the benefit of private persons. So if these three are satisfied, then an international organization is also like excluded. Examples of United Nations and its agencies. What are United Nations agencies? WHO, then UNICEF, all those things, like which are an international organization. World Bank group entities, International Board of Development and Reconstruction, European Union, OECD as well. So these are the practical examples of international organizations which is exempt from BEPS Pillar 2. Okay, so basic thing is it is established by an international treaty, that is a treaty between governments. Okay, now not for profit organizations. Okay, so not for profit organizations are also excluded entities provided it is established and operated exclusively for religious, charitable, scientific, artistic, cultural, athletic, educational, or similar purposes, has income that is substantially exempt from tax, has no shareholders or members with proprietary interest. Okay, so there are nobody who's owning this with proprietary interest, or they do not have proprietary interest in income or assets, cannot distribute the income to private persons except for charitable contribution or reasonable compensation, must distribute all assets to NPO or government account winding up. So if they satisfy all these five conditions, a not-for-profit organization, which is a constituent entity, is also an excluded entity. So, what are the five conditions? One thing is it should be established for religious, charitable, scientific, artistic, cultural, etc. So, those functions are income substantially exempt. Now, what is substantially exempt? I could see that there are 100% exempt. What is substantially exempt? Say, for example, I am a religious organization. Okay, so what I do is if you go to any religious organization, they would be their objects would be to promote the religion, but at the same time they would also be doing something else. They would also make money from selling something like cups. The teacup that I'm selling, or from some beads, or wearables, with the the particular religious sign. So this is basically a commercial activity, right? So what happens is all the donations they are getting for this charitable purpose or the religion propagation, that would be exempt, but all these sales of these wearables and glasses and all these, that would be chargeable. So it is very common in all these religious organizations. So what it is said, that if the income is substantially exempt from its tax and its jurisdiction of residence, then it is okay. Now, as a thumb rule, what people say is if 80% of the income is tax exempt, then it is substantially exempt. Okay, so you can use the same thumb rule, but end of the day, it is not very legally sound. It's just a thumb rule. But if it is 80% of the income, only 20% I get from all these selling cups and all, and 80% is from donations or other income which is exempt, then you are substantially exempt from tax. Okay, and you do not have shareholders or members with proprietary interest. The group structure or the memorandum of the not-profit organization says the shareholders or members do not get any proprietary interest, and the not-profit organization does not distribute income or assets to private person. Obviously, this if such clauses are there, then it is a major loophole, right? You can get back tax-free income, could be basic money laundering also. And also, in case if it is winding up, they should distribute all assets to another not-profit organization or to the government. Then only, because they are just kind of plugging loopholes using the last one, and they should satisfy all five conditions for NPO exclusion. Is this clear? Like not-profit organizations, when it would be excluded? If yes, just give me a thumbs up. It's just basic theory, guys. Yes. Okay. Category 4 is pension funds. Okay, what do we do with pension funds? Like, there are a lot of pension funds which are there, especially in US. So, Minnesota Teachers Association, Teachers Pension Fund. So, this is one example. So, like, what happens is, like, if you have seen this movie, The Big Short, they also talk about pension funds which have invested in toxic CDOs, right? So these what especially they do is like they pull in. This is just like our IAS 19 case. That is for contribution for pension contributions. What they do is they pull in the money, they create a large asset. Okay, and they create large cash and they start investing in certain assets, short term, long term, based on actuarial valuation. So what would happen is, like, the proceeds would be used to pay pensions to all these guys. So classic pension funds, if it is a constituent entity, it is excluded. Okay, now we studied two kinds of pension funds, like defined benefit contribution, and there was one more thing, right? You remember what it was? IAS 19, defined benefit contribution, and okay, that's okay. But so if I have a fund which is owned by defined benefit plan and defined benefit, and there was one more defined contribution plan, right? Defined benefit plan and defined contribution plans. We knew what it was, what was the difference in both, and basically, if I am a company and I have a pension fund which I maintain for the purpose of my employees, and if that is technically, like, a constituent entity, that would be excluded, provided the conditions are satisfied. Like, if it is excluded, if it is established to provide retirement benefits only, it is regulated in the jurisdiction. Okay, so there is a separate regulation, or, like, in UAE, who regulates all these funds? It is a Securities and Commodities Authority. So it, like that, it should be subjected to SCA or similar authorities regulation in the jurisdiction where it established and operates. And it is either exempt from tax, or taxation is deferred until the payments are paid. In UAE, it is tax exempt, but sometimes what happens is, like, tax would be deferred until the benefits are paid. In such situation also, it is an excluded entity as per BIPS. Okay. So one more thing that we have to understand is, if it is a pension services entity, this is like an entity established exclusively to, say, for example, there is a pension fund, which has the money and it has the assets. Just like the staple structure, there may be a pension services entity also, an entity which provides, like, for investing assets, or to provide pension or funds that are to do the ancillary and administrative functions. There would be another entity. Those of the same group are also excluded. Okay, if it is majorly to establish to provide retirement benefits, and those entities are also excluded if it is purely for administration. Then category 5 is investment funds. So, I think we discussed why investment funds need to be an exempt person. This was a major line of discussion we had in while discussing the exempt persons in UAE city also, but I don't mind carrying the discussion here. You tell me, investment funds are big funds, right? BlackRock and major PEs, and now it's a PE run world. Like, all the businesses, if you see, end of the day, it's owned by private equity firms. Now they are the biggest money makers in the whole world. Why would they be put into an exempt category? Why should they not pay taxes? See, that is because these guys, or these big investment funds, what they do is they drive business. Okay, they are the ones which invest money, which enables it gives the basic fodder for our economy to function. And because they should be keeping on pushing money so that the economy is good, we get jobs, and we at end of the day we get food to eat. These guys have to take risk and push money. So, considering their contribution, the government has excluded them for UACT as well. So, same logic, investment funds are excluded in Pillar 2 also, provided they are the ultimate parent entity. Okay. Now, why it is so is because let's say that if an investment fund like BlackRock, it would be having so many M&E groups, right? I mean, if that is also counted as a UPE of a large conglomerate of investments, then it would be so huge. The BlackRock would have no other time but to do administrative functions and pay the top up taxes that could be applicable to all its jurisdictions. So that they said, if end of the day the whole UPE of the major group is an investment fund, sorry, that investment fund is not is an excluded entity. So the respective IPEs would be taking care of the 15% taxes to reduce the administrative burden in investment fund. Did you understand the reason why investment funds, in only if they are a UPE, they're exempt? They bring the money which is very much required for the economy to survive. At the same time, if they become the UPE of a big group, the problem is like they would have no other time but to file GIRs, because part and parcel of their business is investing money in companies. So to reduce the administrative complexities and all, the fund which is at the very top is an excluded entity, and the IPs, respective IPs, would have to take care of the pillar 2 or the jur return filing. Okay. So an investment fund which is a UPE of the group is excluded if it is designed to pull capital from unrelated investors in accordance with the defined investment policy and allow investors to reduce transaction research and analytical costs. Be primarily established for investment rather than trading. So all the mutual funds and all the other PEs which we have. Okay. Same like pension services entity, an investment entity wholly owned by an investment fund is also like used for administration or other purposes, whose the intention is the same as an investment fund. They are also excluded entities. Okay, but there are a few other conditions for investment funds. Okay, so they have to qualify what we call as a ownership test. Again, because a UP investment fund is an excluded activity, this opens up avenues for misuse. So in order to plug that, what they are saying is they should have a minimum ownership test. At least 80% of the value of ownership interest in the fund must be held by persons who are not connected with the fund manager, and either entities or individuals whose income from the fund is subject to tax or held for pensioners or beneficiaries. So what they say is 80% of the owners of the fund, see this might be individuals or etc., they should not be connected to the fund manager. And so basically mutual funds, right? Mutual funds, who pushes it, 80% of the fund of the owners of the NAV, they should not be connected with the manager, and they should be taxed on the income that they receive from the fund. Okay. Or if it is for pensioners use, then it is, or if pension fund is owning the, having a stake in the fund, then like that. But end of the day, this test is very important. 80%. So if I kind of exempt a UPE, then what will happen is I could start something like an investment fund, and I could kind of say that okay, it is an excluded one, it is an investment fund. So to avoid that, only serious investment funds with legitimate business operations are allowed an exclusion, that to ensure that they have an 80% ownership test. Okay. When should you apply the 80%? When did you check the 80%? At the end of the year. Okay, you have to look at the ownership throughout the year and see whether in any time you have crossed this 80% threshold. So if you fail to kind of 80% test is failed, all the investment fund loses exclude status and the entire group becomes subjected to blue card. So it is very, very, dicey. So it is not worth missing it at all. So we should not be you should check this 80% status with respect to investment funds at all times. So just to kind of give you a summary, what are excluded entities? For to check if it's an excluded entity, you have to first check if it is a constituent entity. If it is a constituent entity, you have to see if it falls into these five categories. If it is not a constituent entity, then don't even think. It stops here. If it is a constituent entity, you have to see whether it falls into five categories. A government entity, but a government entity which does trading or investing is not excluded. Only those which perform sovereign activities would be excluded from the scope. or from the pillar 2 mandate. Now, international organization, you have to look whether there is a treaty, there is a treaty between governments by which this international organization is established. Only if that treaty exists, then and also, like, they should be given at the headquarters level, they should give a tax exemption, and so only legitimate international organizations should be considered. Not profit organizations, they have five conditions to meet. They have to meet all five conditions. If you recall at least four, five, then first thing is it's for religious, charitable, or athletic, or etc. purposes. Second thing is their income should be substantially exempt in the jurisdiction where it is still. We understood what is substantial exemption. Like, on a thumb rule, 80% of the income should be exempted. And their income and assets should not be held by individuals, okay, or body corporate, or like, and at the time of, they should not pay any salaries or income to any individuals unless it is actually, like, if they are doing some services and they are getting a salary, that's fine. Unless legitimate purposes, they should not be disbursing any funds to individuals. And fifth one, if they are kind of winding up, they have to distribute their assets to the government or another non-profit organization. It should not go to any private parties. Okay, so if all these five conditions are met at all times, then it is an excluded entity. Pension fund, we know, like, there are three conditions for pension fund. If you recall, it is for payment of pensions, and so if we can, yeah, it is to provide retirement benefits. It is regulated in the jurisdiction, and either the income is exempt or the taxation is deferred till the benefits are paid. Okay, so if these three conditions are satisfied, then pension fund is also excluded. Investment fund, it should be the UPE, and 80% of its ownership should be from people who are not related to fund manager, and those people who for whom the income derived from the investment fund, say capital gains or dividend income, should be taxable in their own hand. So in case if that is only meant, then investment fund is exempt. So this is just basic theory. Okay, this is why certain entities are excluded, and the reasoning for that. It is at par, it is at parallel, or it is at complete hitting the same nodes as why there is an exempt person in UAE corporates. Okay, so how do you do a step-by-step excluded entity assignment? You have to first look at the, now operationally, if you are looking at excluded entity, you have to first look at the constituent entity register, and you have to see whether it may fall in any of the five excluded categories. You have to get, once you see that, okay, it is a pension fund, it is an international organization, it is a investment fund, then you have to gather entity information. Okay, choose them and get all these information, like, if it's a government entity, charter, formation documents, ownership evidence, description of activities. If it's a pension fund, like, I told, we discussed that it should be regulated, so regulatory registration, tax status confirmation, fund rules, etc. So you get all the documents. One, you get the apply documentations and apply exclusion tests. So work through each exclusion test systematically, document your analysis for each criterion. For investment fund, please confirm if the entity is a UP and not a subsidiary. Verify the fund structure. Verify if the fund structure meets the investment fund definition. Calculate ownership percentages for 5 years at least. This is for the 80% rule, and assess each investor's tax status. And you document, prepare a memorandum for excluded entity also, where you would be having all these things: entity name, applicable exclusion category, evidence, date of assessment, and when you would review next. So review frequency as well. Now, while doing this assessment of excluded entities, common challenges we face is commercial entity versus. So whenever we see a commercial a government entity, we say that okay, it is excluded. No, if government agencies that conduct commercial activities, then it is not excluded. Okay, so the key indicators are, like, how do you identify if it is doing a commercial activity? Revenue from goods and services are sold at market prices, it's not at a rationed price. Competition with private sector entities, and it has profit making objectives, then it is a commercial entity, even though wholly owned by the government, and it would be not an excluded entity for web's pillar 2 purposes. Okay. And the NPO substantially exempt test. I told you why there is a substantial, why the wording used is substantially exempt in terms of non-profit organizations. So, as a practical threshold, if 80 plus percent of the tax is tax exempt, it is substantially exempt. Okay. So, that's kind of a thumb rule. Don't ask me where it is legally written, no, but it's how you kind of like talk to the tax authorities and streamline it. For pension fund subsidiaries, like you have to understand that pension services entities are also excluded. So when we see that it is not the pension fund, we may kind of put it in the included category. No, pension services entity is also excluded. Okay. And yes, this is the major challenge, because I told you that 80% of the owners of the fund should not be relatives of the relatives of the asset manager or known to the asset manager. And also, like, they should be taxed in the jury. It's very difficult. Trust me, if you look at a fund, there would be multiple owners. If you look at a mutual fund, which is a constituent entity, you see that it is day to day people are like buying, selling it. It is very difficult to track who is kind of owning what. So you have to obtain investor register from the fund administrator, categorize the investors into individuals, pension funds, taxable entities, tax exempt entities, and calculate the percentage by value, not by number of investors meeting the test. So what do you mean by calculate the percentage by value of investors meeting the test and not number? So you have to see how much is their investment. So what is the value? You have to calculate the investment. So 80% of investors, meaning 80% of the owner, those earning the ownership status, not by the number. And document the instances where the investor cannot status cannot be made. So once you've done all that, once you've done the excluded entity assessment, you have to do documentation. The first documentation is excluded entity register, and this is the only documentation. Trust me, you have to have an excluded entity register, and you have to give all these things like entity name, jurisdiction, country of residence, exclusion category, key criteria met, how each criterion is satisfied, what are the supporting documents you have, date of initial determination, the assessment date, when would you be doing the next review to see whether it's excluded or not, and who is the person who's doing. So if all these things are there in your documentation, in your file, it is perfect. So just to kind of like so that at least review annually. Okay, so that brings an end to chapter 1. Okay, today's class is just kind of peeking at excluded entities. What you have to understand is there are 5 excluded entities. Okay, the government, but if government is doing a trading or competing with the private sector, no. Then there is international organizations which have an international treaty with the governments. Then there is not-for-profit organizations. 5 conditions they have to satisfy, all 5 conditions. Then there are pension funds which have to satisfy 3 conditions. It should be for disbursement of pensions, and it should be regulated, and it should either be exempt from tax or it would be deferred for taxation. Then fifth one is investment entities, investment funds rather. Investment funds only if they are a UP, that's when it is an excluded entity. Otherwise, it is included. And a major thing about investment funds is they have to have the 80% ownership test. Is it clear? I just ran through because it's nothing but theory. Okay, it you could easily get it by simple reading, because there is not much legal difficulty here. Wherever there was a legal difficulty like substantial exemption and what is pension fund, we kind of like spent some time there. But other than that, I don't see any challenges in understanding excluded entity assessment. So it is just basic routine that we have to do as a part of pillar 2 analysis. Is it clear? Like, excluded entities, 5 excluded entities. So not just the equity method investee, but these entities would also be excluded from the scope of pillar. Getting it? Okay. Now, what we would do is we would kind of do charging provisions tomorrow. So initially it was the scope, like identifying the characters. Now we will get into the plot. Now these would be even more complex than what we studied in chapter 1. Chapter 2 would include IAR, UTPR, rules and interaction topic tax. Now, it is not much about theory, but more about numbers. So we would be doing some calculations as well. Like, we'll be doing plenty of examples as to how IAR, UTPR, and top up tax allocation is being done. So brace yourself for next week. But before we move into all this, it would be great if you can do the assignment for chapter one. I'll send you the assignments today, and take the whole weekend, tomorrow, day after, and then try to do it by yourself. Please do not use an AI because it's very easy. End of the day exams, you have to write it down, so take it as a practice for the exams. Okay, and please be open to make mistakes, and once you make mistakes and you get corrected, you will never forget it. So take it up, like, it will take maximum half an hour to 40 minutes, the assignment, to type it down. So don't worry. I'll be sharing it with you now, and we'll see you on Monday. Okay.